Imagine carrying a debt so vast that it stretches back over 1,000,000 years. This is the reality of America's debt crisis. The United States government is projected to spend about $6.5 trillion in 2024, which is roughly $2 trillion more than it will collect in taxes. The government can't simply create this extra cash out of thin air, so every dollar it spends beyond tax revenue piles onto the national debt. To truly grasp how enormous the $35 trillion national debt is, let's put it in perspective. If $1 equals 1 second, then $1 million, or 1,000,000 seconds, would amount to around 11 days. $1 billion, or 1 billion seconds, translates to about 31 years. When it comes to $1 trillion, or 1 trillion seconds, we're looking at roughly 31,688 years. Now, if we consider $35 trillion in seconds, we're talking about an eye-popping 1,109,000 years. This gives us a clearer picture of the huge amount of debt the US government is carrying. The critical question now is whether this situation is truly a problem, and if so, how serious is it? Being in debt isn't a new concept for the United States. It first went into debt during the Revolutionary War in 1791. However, in the last century, the national debt has really skyrocketed. To understand this issue, it's important to know two key terms: national deficit and national debt. The national deficit occurs when the government spends more money in a year than it collects in taxes. For example, in 2024, the government plans to spend about $6.5 trillion while only bringing in about $4.5 trillion in taxes. This results in a $2 trillion national deficit, which adds to the total national debt, the cumulative amount the government owes year after year. What's important to focus on isn't just the size of the debt, but how it compares to the nation's assets. Imagine you own a home worth $2 million, but owe the bank $1 million on your mortgage. Is that a problem? Not really, as long as you can afford the monthly payments. However, if your home is only worth $500,000, owing $1 million could become a serious issue, especially if you struggle to make those payments. In this scenario, the collateral for the US is its economy, measured by GDP, which reflects all sales in the country. To illustrate this better, let's look at the national debt over the past 4 decades and compare it to the size of the economy. In 1984, the US national debt was $1.5 trillion, or 39% of the total GDP. By 1994, it had climbed to $4.7 trillion, which was 66% of GDP. In 2004, it rose to $7.3 trillion, but the debt to GDP ratio actually dropped to 60%. That seemed promising, but from 2004 to 2014, the national debt surged to $17.8 trillion, reaching 101% of GDP, meaning the debt was now greater than the economy itself. Today, the national debt has skyrocketed to over $35 trillion, or 121% of GDP. Is this a problem? Going back to the earlier example, if you owe more than your house is worth, it's not necessarily an issue if you can keep making payments. The government isn't a profit-making business like Amazon. It relies on tax revenue from citizens. People work, earn money, and pay taxes. This tax money funds everything from infrastructure and military to education and debt repayment, including interest on the national debt. While the government's expenses have been climbing steadily over the years, its tax revenue has also increased. The trouble is that expenses are rising faster than the income from taxes. This mismatch is at the heart of the growing debt issue. The most surprising part about the US government spending is that the fastest growing expense isn't the military, Social Security, or healthcare. It's actually the interest payments on the national debt. With the debt now at $35 trillion, the interest alone costs more than what the government spends on the military. So how does the government pay back this money? It relies on taxes. While tax revenues are increasing, they aren't rising fast enough to cover the growing costs. This leaves the government with two main options: raise taxes or introduce what can be called a hidden tax. When the government raises taxes to fund an expense, it's clear who's paying for it. For instance, if a new 1% tax is added for wealthy individuals to build a bridge, it's obvious that the wealthy are footing the bill. Similarly, if a new tax is introduced, there's a direct link between the source of the money and its use. Although this isn't necessarily the most efficient use of funds, it helps everyone understand how the tax system operates. The government can either raise taxes on some or all of its citizens to fund various needs, including repaying the debt and its interest. However, the government also has the option of spending money without approving a new tax bill. This leads to a unique situation. If the government wants to spend $1 trillion that it doesn't have, it still needs to find that money. Since the government can't simply print money, it borrows what it needs. Individuals and institutions can lend money to the government by purchasing U.S. Treasury bonds. The issue here is that the government has already borrowed $35 trillion, which can't be covered solely by private citizens and businesses. This is where the government turns to the Federal Reserve Bank. Despite its name, the Federal Reserve Bank is not a federal entity, nor does it have cash reserves like a traditional bank, where people can deposit their money. However, it serves as the central bank of the United States and has a unique ability. It can create money. When the government needs to spend more than it has, it can call on the Federal Reserve to print money. The Federal Reserve can then create this money and lend it to the government, which can use it for various purposes, such as infrastructure projects or paying off debt. However, this approach comes with its own set of consequences. When it comes to paying taxes, it's clear who bears the cost. If you pay taxes, you know you're contributing. But what about when the Federal Reserve prints money? Who pays for that? This is what's referred to as a hidden tax. If the source of payment isn't clear, there's a good chance it's the everyday consumer who ends up covering the cost. When the government creates money through the Federal Reserve, it increases the total amount of money in circulation. Because US paper dollars aren't backed by gold or any precious metal, each dollar's value decreases as more are printed. The inflation seen in 2020, 2021, 2022, 2023, and even into 2024 is a direct result of the government and the Federal Reserve printing trillions of dollars out of thin air. This influx of cash has diminished the value of each individual dollar. The term inflation comes from inflate, which means that when inflation occurs, the money supply is increasing, leading to a decrease in each dollar's value. As the dollar's value drops, prices for goods rise. This impacts everyone because, ultimately, everyone is a consumer who needs to buy food, groceries, and other essentials. While consumers feel the pinch of rising prices, those who are financially savvy, like investors, can actually benefit from inflation. This inflation can drive up the value of investments, stock portfolios, and rental properties, providing financial gains for those who understand the market. However, inflation is not a new phenomenon. It has been occurring for decades. The Federal Reserve aims for a 2% inflation rate, but it raises questions. Why not a 1% or 3% target? Why does the Federal Reserve not want zero inflation? Zero inflation would mean that consumers don't have to worry about rising costs. Furthermore, why doesn't the Federal Reserve target a negative 2% inflation rate to counteract the high inflation of recent years? This scenario creates a headache for the Federal Reserve and the US government, especially with a staggering $35 trillion in national debt. Deflation, which is when prices decrease, can make debt even more burdensome. If inflation reduces the value of money, then deflation does the opposite, making every dollar more valuable. While having cash during deflation is beneficial, for those in debt it means paying back loans with more valuable dollars, which can make existing debts much more difficult to handle. Deflation is concerning for the government and the Federal Reserve too, even though it might benefit the average person. When inflation is at 0%, it doesn't help the government because inflation allows them to pay off debt using cheaper dollars. It's important to grasp this because the economic system primarily favors investors rather than employees or consumers. This isn't to say being a consumer or an employee is bad. In fact, most people should be employees. However, it's essential to become financially educated and learn to invest so one can succeed in this system. The issue arises only if the government struggles to make its payments. Currently, the government is managing to make its payments, but questions remain about how long that will last. Discussions have emerged about the government's rising interest expenses. If they continue to increase, the government might resort to borrowing money to cover those payments. That's when problems truly begin, akin to using one credit card to pay off another. Although the situation isn't dire yet, the US government is at a point where it has collateral issues. The next question is whether the value of that collateral, like home prices, will increase faster than the debt. If it does, that would be positive news, as assets would rise and help pay down debt. Conversely, if debt and interest payments continue to rise to unsustainable levels, the government might have to borrow more money to cover those costs. Time will reveal what happens, so it's vital to be a financially savvy investor and understand the current economic landscape. So, subscribe to our channel and stay connected.